If you're in your 60s and nearing retirement, the biggest mistake you can make is tying next year's income to the stock market. That's not investing. That's gambling with your lifestyle. You see, when you're working, a market dip is annoying, but you're still saving and you've got years to recover. In retirement, it's different. You're spending from your saving. And if you're forced to sell when the market is down, bad timing can derail your entire retirement plan. That's why I encourage retirees to think in terms of buckets. Bucket one is your cash bucket. This is the money you'll use for the next year or so for income. Many couples I work with love knowing their next year's income is already set aside and safe. With this portion of their money, they don't care if the market is down or what it's doing on a day-to-day basis, because their paycheck is already covered. That cash buys you peace of mind. Now, I'll admit, it's easy to get restless when the market is ripping and you have a portion of your money sitting on the sidelines not participating. But having worked with clients through enough market downturns, I can confidently say that they are all glad they had some cash during bad times. Bucket two is for stable income. Think of this as your bridge. Investments like bonds and annuities that provide steady income. This gives you a layer of predictability so you don't have to touch your long-term growth money during downturns. And bucket three is for growth. This is where long-term investments live. Investments like stocks, bonds, and real estate. Things you won't touch for several years. And because you have bucket one and two in place, you can afford to leave this money alone and let it recover after a market downturn. This approach is what allows retirees to stay calm when headlines scream market crash. Instead of reacting in fear, they know their short-term income is already covered. Look, having a portion of your investments in cash isn't lazy. It's insurance against bad timing. And if you're wondering whether your retirement plan has enough cushion built in, let's talk. Because when the market dips, and it always does at some point, you'll be glad you had a strategy that kept your income safe.